Regarded as one of the best investors of all time, Peter Lynch knows how to make money and multiply it. Lynch was an investing unicorn. His Magellan Fund at Fidelity gave him an unbeatable 29% return from 1977 to 1990. In those prosperous 13 years, he turned $18 million to $14 billion with a B. He truly is a dime in a dozen, but when we analyze exactly what his strategies are, we can get a sense of why he's so good at investing. So, what made Lynch such a successful investor? Well, he had a unique philosophy when it comes to investing, and we're going to explore exactly what he did to become so successful. And the best part? It's not just some outdated strategy from the past. Lynch's approach is just as relevant today as it was when he was running the Magellan Fund. So, if you're ready to learn from the one-up on Wall Street master himself, stay tuned to find out. When there are mutual funds, ETFs, individual stocks, crypto, gold, and everything else you can invest in, it's hard for the average investor to figure out exactly what they should be investing in. It's easy for a normal person to just give their money to a fund manager and let them take care of the rest. While this is not a bad idea, Peter Lynch recommends a different approach. He firmly believes that individual or retail investors have the upper hand and hold a significant advantage in terms of making wise investing decisions. It sounds contrarian, right? So, if you suck at math, don't have a lot of money, and don't know where to begin, then you might ask, how can you beat hedge fund managers at their own game? Peter Lynch's answer is simple. It's because retail investors like you and me are able to see things that fund managers don't. Oftentimes, fund managers have someone to report to and have very specific formulas or methodology to come up with investment strategy. They're preoccupied with the noise of what Mr. Market is doing and often look over the details that matter the most. This means Peter Lynch wants you to do your homework and do your own research. While it does require a bit of effort, it'll be well worth it if you want to make cash money rein in your future. Now, the start of 2023 hasn't been exactly all sunshine and roses. You'd think that coming out of the pandemic, we would be in a bull market, but that's not the case anymore at all. Inflation continues to run rampant, and the Fed keeps raising interest rates. Oh yeah, by the way, a few banks have collapsed because of the rate hikes, so market conditions are definitely choppy, with a recession most likely in the forecast, according to some analysts. But when things get tough, Peter Lynch does have words of wisdom to put things into perspective. Lynch simply says these two important things when market conditions are tough. The first one being, you can't control macroeconomic conditions. No one could have predicted that a war in Eastern Europe would happen and dramatically affect oil prices. No one could have really known the extent of what the pandemic did when the Fed started printing money, thus causing high inflation. No one could have predicted that a few small regional banks would start failing when interest rates got higher. But Lynch also says that there's a 100% correlation between a company's earnings versus what happens to the stock market over a few years. In other words, invest in amazing, durable stocks with great earnings because those tend to outlast choppy market conditions all day, every day. His second piece of advice is one that still resonates today. Now, when you put your hard-earned money into something, chances are you would want to invest it in something that you already know. This doesn't mean you should go out and buy stock in your favorite restaurant chain just because you like their food. It means you should use your own knowledge and expertise to identify companies that have the potential for growth. For example, if you have a good old combustion vehicle and you're in the market for a new car, chances are you've broadened your horizons and looked at electric vehicles. With more research regarding different types of EVs, cost savings, car companies, and everything in between, you naturally become somewhat expert when you're a consumer. Again, most fund managers only see certain things in the investing world without the peripherals or other perspectives. As an individual investor, this once again is an example of having an advantage over Wall Street. Another example of this is, if you work in the healthcare industry, then you're knowledgeable about health trends, equipment, and research that most people may not know about. Point is, you should invest in what you know. It makes investing not only more enjoyable, but meaningful as well. What makes Peter Lynch so zen in times of crisis is the fact that he doesn't panic and sees the stock market so clearly. It's natural for stocks to go down after long periods of high, just as stocks take a dump during periods of bear markets and recessions. Take the pandemic, for example. From March 2020 to December 2021, the S&P 500 shot up about 70%. This was an insane time period because the average rate of return is about 7 to 10%, so this was unsustainable. It also made sense because interest rates during this time were at an all-time low. The Fed pretty much kept interest rates close to 0% to stimulate the economy. Now, if we take a look at December 2021 to the end of March 2023, the market is down about 16%, and the federal funds rate is nearing 5%. Peter Lynch keeps everything in perspective and actually believes it's healthy for the stock market to cool off. To combat the turbulence, Peter Lynch recommends buying and holding for the long term. No one will know what the market is going to do in the next 1 to 2 years, but almost always if you invest long term in high-quality stocks, you're bound to get a decent return. Similar to Warren Buffett's investing style, Peter Lynch looks for wonderful companies on sale. Just like when you buy TVs on Black Friday, the stock market is no different. Companies you know and love will now have the opportunity to be discounted and purchased at a lower price. During that upward trend in the stock market following March 2020, because of the Rona, most of the wonderful durable companies were overpriced. After evaluating a company and seeing its true worth and if it falls within the margin of safety, that's when you strike and purchase that stock. The margin of safety is not for the faint of heart because it requires what many investors lack, and that, my friend, is patience. If you've identified stocks that you like that meet your interest, all you have to do now is wait for the stock price to come down to where you feel it's safe to buy, hence a margin of safety. Maybe the most notable advice Peter Lynch has for investors in 2023 is to not time the market. He calls it a waste of time. He gives an example that in the 13 years he ran his fund Magellan, the market had a downturn of 10% or more on 9 separate occasions. For most people, they may have called it quits due to the rapid decline. But once again, Peter puts things in perspective. He realized that the upside of his investments continually beats the downside because he's done his research, and with time, the market continually goes up. Patience once again plays a key role, and investors have to stomach the downturns if they want to celebrate great returns. When it comes to 2023, many people are predicting a recession, and while many are trying to time the market, Peter Lynch does not advise to do so. In the long run, it'll go up, and investors are essentially just going to be wasting energy trying to predict the unpredictable future. When we take a look at Peter Lynch's style and his investment, they're diversified across many industries. However, he does have a notable system in place. In his 1987 letter to Magellan stakeholders, Lynch stated that diversification is key, and he held a mix of growth companies and value stocks. The fund has normally had between 20 to 35% in conservative stocks and bonds, and 65 to 80% in more aggressive companies. You kind of think of it as capitalizing on growth while hedging your bet against the downside. Ultimately, Magellan's original goal was to just beat the market by 5 to 6% each year, and that he did. Now, if you were wondering what stocks he held, these included Fannie Mae, Ford Motor, Philip Morris International, Taco Bell, Dunkin' Donuts, and General Electric. It's kind of crazy because most popular names are still around today, with the exception of Fannie Mae, of course, but that's a different story. Diversification not only means investing in different sectors across the stock market, but it also means knowing how many stocks you should hold at a given time. According to Peter Lynch, he recommends holding 10 to 30 stocks at a time. That way, in case one industry fails, another industry may prop up your portfolio. You're essentially hedging yourself against a downturn across many industries. The smartest investors typically play a strong defense during any moment of a stock market crash. For instance, due to the recent bank collapse of Silicon Valley Bank, Signature Bank, and Silvergate, the financial sector got a beatdown, and if you just held a couple of stocks in finance, you'd be in a lot of pain right now. That's why you choose multiple industries with businesses you understand across 10 to 30 stocks. Additionally, Peter Lynch also recommends that there shouldn't be a stock that's weighted more than 5% of the total portfolio. Peter Lynch's investment style was centered on the principles of understanding what you own, investing in a diversified portfolio of stocks, and conducting thorough research on potential investments. While Lynch's strategies have proven successful in the past, it's important to note that investing is inherently unpredictable and subject to market volatility. Now more than ever, it's crucial for people to evaluate their own financial goals and risk tolerance when deciding on an investment approach. For most people in 2023, it's generally recommended to invest in a diversified portfolio and avoid trying to time the market. No one is a Nostradamus in the investing world, We can only analyze the information that's available to us. So during times of uncertainty, it's time to hunker down and research companies that you know and love. A long-term approach that prioritizes consistency, diversification, and risk management is likely to yield the most successful outcomes over time.